Arm delivered exactly $1.49 billion in quarterly revenue, yet their core operating profitability is actually shrinking right before our very eyes. When a company prints record top-line numbers alongside world-class margins, how is it even possible that their underlying earnings quality is flashing massive warning signs? But does this mean the broader market is entirely wrong? Or is there a hidden, fundamental value that Wall Street is completely ignoring today? Total revenue surged 20% year over year to reach that $1.49 billion mark. Headlines are screaming about this top-line beat, assuming the artificial intelligence infrastructure boom is an unstoppable force. But when you look at the Q4 gross margin of 97.9%, you see absolute pricing power. They are selling pure intellectual property, essentially taking a lucrative cut without ever touching physical hardware like server racks or consumer laptops. But here is the fascinating paradox hidden within the data. The Q4 operating margin contracted sharply to 29.4%, falling down from 33% just 1 year ago. Why did their operational profitability drop so aggressively? Because Arm is now aggressively pivoting from simply licensing software directly into building physical hardware, specifically advanced compute processors for massive data centers. Competing in this physical space means eating heavy research and development costs, which hit $698 million this quarter. A high gross margin is ultimately useless if operating expenses spiral out of control to fund unproven physical product lines. Proper stock market analysis requires looking past the surface to see the true cost of doing business. But to fully grasp why this earnings report is complex, we need to look at who is actually generating this $1.49 billion revenue figure. Q4 related party revenue exploded by 85%, hitting $411 million. At first glance, the consensus view assumes this is standard business growth across the technology ecosystem. But when 27.6% of your total revenue comes from affiliates and sister companies, you must ask how much is independent organic demand. And it gets significantly more concerning from a strict accounting perspective. Related party contract assets practically quadrupled year over year to reach a towering $646 million. This effectively means Arm is booking massive revenues from its closest affiliates without immediately collecting the physical cash. Unbilled receivables stacking up like this clouds visibility into genuine market demand, making that $411 million related party revenue figure look incredibly risky. This is something you can easily check for yourself in any quarterly filing. You always have to know if the cash actually hit the bank account, or if it is just a paper promise. This fundamental principle is an absolute cornerstone of sound value investing. This brings us to the real elephant in the room regarding Arm's long-term predictability. The remaining performance obligations dropped 7% year over year, landing at $2.07 billion. Most analysts are purely focused on those current quarter sales, completely ignoring what that $2.07 billion pipeline looks like for tomorrow. For a typical licensing business, a shrinking remaining performance obligation metric is a critical warning sign that the company is burning through unearned revenue faster than it signs new deals. What does this actually mean for your personal investing strategy? It means the premium valuation you are paying requires flawless execution, and a 7% shrinking backlog gives management very little margin for error. You always want to see the backlog growing faster than recognized revenue to guarantee long-term stability. Once you grasp this concept, you will begin to look at financial reports in a completely new light, constantly focusing your attention on tomorrow rather than yesterday. If the pipeline shrinks, we must question the true cost of their daily operations. Q4 GAAP net income was reported at $313 million. Institutional desks are entirely captivated by the adjusted non-GAAP net income, which was artificially inflated to a massive $641 million. How do you practically double your own profit on paper? You do it by adding back $261 million in quarterly stock-based compensation. Arm is heavily diluting retail shareholders to subsidize the skyrocketing cost of retaining elite engineering talent in a highly competitive market. This highlights a growing divergence between the adjusted profits management wants you to see and the actual cash equivalent cost of running the business. The lesson here for fundamental analysis is incredibly simple but powerful, that $261 million stock-based compensation directly reduces your ownership stake. Using equity to fund payroll limits the upside of your investment, serving as a silent tax on your returns. That dilution leads directly into the reality of their cash generation. Despite robust reported net income growth, Q4 free cash flow actually declined by 7% year over year, landing at $152 million. This pushed the Q4 free cash flow margin down to a modest 10.2%. The broader market generally forgives a very slight cash dip during high growth phases. However, this cash flow squeeze is the direct result of heavy working capital consumption and elevated capital expenditures, which officially hit $74 million for this specific quarter. Building actual physical chips for complex servers requires massive amounts of upfront cash that pure software licensing simply does not require at all. When that 10.2% free cash flow margin contracts during a revenue boom, it signals that the underlying business model is becoming more capital intensive. Successful value investing demands a strict focus on cash flow because cash is the ultimate truth teller in any corporate turnaround. Fortunately, Arm has an underrated financial cushion that protects them while they navigate this pivot. Total cash and short-term investments stand at an incredibly robust $3.6 billion. Even better, they currently carry absolutely $0 in traditional debt on their books. This flawless balance sheet gives Arm an asymmetric advantage over legacy hardware competitors burdened by high leverage. It gives management the massive runway needed to fund their strategic shift. Management claims this shift has already generated over $2 billion in forward customer demand for new physical processors. But your investing strategy must weigh that long-term promise against their immediate Q1 revenue guidance of $1.26 billion, alongside Q1 earnings per share guidance of 40 cents. If they miss that earnings target by even a few pennies, stock market analysis indicates a high probability of a severe multiple compression as investors begin to reprice the heavier business model. So we return to our opening question. Is this record-breaking $1.49 billion revenue a sign of structural dominance or an illusion masking deeper fundamental shifts? The ultimate verdict is that Arm is executing a highly ambitious, high-stakes pivot. They are transitioning from an asset-light intellectual property vendor into a very capital-heavy chip seller. While their zero-debt balance sheet provides a massive structural advantage today, the underlying metrics simultaneously reveal contracting margins, heavy reliance on related-party sales, and a rapidly shrinking backlog. Does the current valuation offer a margin of safety for new buyers when the operating margin has fallen to 29.4%? It currently prices in perfect execution of their hardware strategy while completely ignoring rising research costs and continuous shareholder dilution. Arm remains a phenomenal business with incredibly deep moats in mobile technology, but you must closely watch their free cash flow and those $646 million in related party contract assets in all of the upcoming quarters. Always look beneath the headline revenue to find the absolute truth hidden deep within the financial footnotes of these corporate earnings reports. But I want to hear your take. Will Arm's risky physical hardware pivot justify its massive market valuation? Or is this a classic value trap hiding in plain sight right now, just waiting to catch unsuspecting investors off guard? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.